Understanding Investments a Few Minutes at a Time by Daniel Dower, from Chapter 9, Fundamental Analysis, issue number 38. An investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. Operations not meeting these requirements are speculative. Benjamin Graham. Shareholder-friendly management. In addition to earning money, the executives that run a corporation are responsible for allocating those earnings and the other capital of the company. How they do so is incredibly important to long-term shareholder wealth. Whether they expand operations, make acquisitions, enter new business, pay down debt, pay dividends, repurchase stock, or any number of other choices. Warren Buffett's 1987 letter to Berkshire shareholders suggests this skill is not something that comes naturally. Quote, "The lack of skill that many CEOs have at capital allocation is no small matter. After 10 years on the job, a CEO whose company annually retains earnings equal to 10% of net worth will have been responsible for the deployment of more than 60% of all the capital at work in the business." Close quote. He continues, quote, "CEOs who recognize their lack of capital allocation skills, which not all of them do, will often try to compensate by turning to their staffs, management consultants, or investment bankers. Charlie and I have frequently observed the consequences of such help. On balance, we feel it is more likely to accentuate the capital allocation problem than solve it." Close quote. There is no reason to assume that profits made by a certain company are necessarily best deployed within that company, given the countless choices we have for investment. By returning money to the shareholders, they let each of us decide for ourselves how best to allocate our capital. It seems crucial to any investment that executives acknowledge that the company belongs to its shareholders, for the benefit of its shareholders. Companies vary widely in this practice. For example, Google, one of the highest market capitalization companies in the world, has a well-established policy of returning no cash to shareholders. None. They neither pay dividends nor buy back stock, and have stated no plans to do so. Such statements make me scratch my head a bit, wondering exactly who would want to invest in such a company and why. I understand that analysts estimate its earnings growth at 15% going forward. But ultimately we must ask, to what end? Investing in any asset whose value is measured solely in the eye of the beholder is speculation, by definition. I prefer companies such as Procter & Gamble, another of the world's most valuable companies. From 2010 through 2012, P&G paid out 86% of earnings to shareholders in the form of dividends 54% and stock buybacks 32%. Still, analysts estimate 5-year growth at 8.3% annually. To the extent executives can redeploy capital intelligently, they do, and I encourage it. If they cannot, I'd rather try my own hand at it. I appreciate it when they understand that as well. Most companies track return on incrementally invested capital, ROIC. However, few publish that information, at least not in any easily accessible format. McDonald's annual report provides calculations for 1-year, 3-year ROIC, which tend to range from 15% to 40%. While I don't recall the exact verbiage, I listened to an online recording of a McDonald's investor conference that I found insightful. When asked a seemingly obvious question, quote, "If ROIC is 40%, why not invest more capital?" Close quote. The answer was breathtakingly simple. Quote, "If we did, it wouldn't be 40%. Close quote. In recent years, McDonald's made a conscious choice to focus on quality capital allocation, returning excess to shareholders. From 2010 through 2012, they returned 97% of earnings to shareholders, 50% through dividends, 47% through buybacks. Yet still, earnings grew 10% annually. Quoting Benjamin Graham, "It is our belief that shareholders should demand of their management either a normal payout of earnings, on the order of, say, 2/3, or else a clear-cut demonstration that the reinvested profits have produced a satisfactory increase in the per-share earnings."